Most gyms make their money from people who don't show up. In fact, many gyms would struggle to survive if most members actually use the equipment they pay for. That sounds wrong. Gyms sell fitness, health, and access. Demand keeps rising. Locations keep opening. Yet profitability across the industry remains thin and fragile. Within months of opening, many gyms sign hundreds or even thousands of members. Monthly fees add up quickly. On paper, the model looks simple. Low-cost memberships multiplied by high volume should produce steady profit. But beneath that surface is a core tension. Gyms need members who pay consistently, but not members who show up too often. The behavior they promote works against the economics that keep the business stable. Fitness has become a central part of modern life. More people track their health, follow training programs, and join gyms than ever before. Gyms sit at the intersection of health, retail, and real estate. They occupy large physical spaces. They rely on long-term contracts. They promise personal improvement at scale. Because of that, gyms often appear durable and resilient. People want to stay healthy in good times and bad. But the gym business is not primarily about fitness. It is about managing utilization. Utilization measures how much of a service's capacity is actually used. For gyms, this is the defining challenge. Equipment, floor space, locker rooms, and staff are fixed costs. They exist whether one person shows up or 100. Revenue comes from monthly dues that are relatively low and often discounted to attract volume. Most gyms operate on a subscription model. Members pay a recurring fee in exchange for access. That fee is usually set low enough to feel manageable. The goal is to reduce friction at sign-up. Once enrolled, many members stay longer than expected. Some attend regularly, many do not. This pattern is not accidental. The model depends on it. Gyms are built on the assumption that only a small share of members will be present at any given time. Treadmills, weight machines, and group fitness rooms are shared resources. If even half of members tried to use the gym daily, congestion would rise quickly. The experience would suffer. Staffing costs would increase. Equipment would wear out faster. Cleaning, maintenance, and utilities would climb. Margins would compress. This creates a quiet contradiction. Gyms market consistency and discipline. Financially, they rely on inconsistency. The most profitable member is often the one who signs up with good intentions and slowly stops coming while continuing to pay. The cost structure reinforces this imbalance. Rent is usually the largest expense. Gyms require large footprints, often in visible retail locations. Lease terms are long and difficult to change. Equipment is capital intensive. Machines are expensive, depreciate quickly, and require ongoing maintenance. Staff are needed to sell memberships, supervise floors, clean facilities, and run classes. Utilities are high. Lights, climate control, and showers operate for long hours. Most of these costs are fixed or semi-fixed. They do not decline when attendance drops. Profitability depends on stable membership revenue. Competition keeps prices low. New gyms enter markets frequently. Many differentiate through branding, amenities, or classes, but the underlying economics remain similar. This dynamic is clear in the case of Planet Fitness. It is one of the largest gym chains in the world by membership count. Its pricing is intentionally low. Basic memberships often cost around $10 per month. That price attracts a wide audience, including people unsure about long-term commitment. Planet Fitness is explicit about a strategy. It targets casual users. It emphasizes a non-intimidating environment. Its locations are designed for light to moderate usage across a large member base. Attendance data is closely monitored. The company expects that only a small percentage of members will visit regularly. This allows Planet Fitness to enroll far more members per location than a traditional gym could support if everyone attended frequently. The model works as long as behavior remains predictable. If attendance rises materially, congestion increases and costs follow. The economics weaken. The pandemic exposed how sensitive this balance is. When gyms were forced to close, membership revenue dropped immediately. Fixed costs remained. Rent, debt, and equipment payments continued. Many gyms survived only by freezing memberships, renegotiating leases, or raising capital. Smaller operators without scale or strong brands struggled the most. After reopening, behavior shifted again. Some members returned, others canceled. New signups slowed. Gyms faced higher labor costs and stricter cleaning standards. At the same time, at-home fitness options improved. Streaming classes, connected equipment, and outdoor workouts offered alternatives that required no commute and no long-term contract. This period revealed something deeper. Gyms are not just selling access to equipment, they are selling a habit. Habits are fragile. When routines break, revenue becomes unstable. The lesson extends beyond fitness. Gyms belong to a broader category of businesses that depend on predictable underuse. Airlines rely on overbooking. Insurance depends on pooled risk. Gyms rely on good intentions that fade over time. These models can work, but only when behavior stays within narrow bounds. When that balance shifts, margins disappear quickly. If too many members show up, costs rise. If too many cancel, revenue falls. There is little room for error. That is why many gyms appear busy but remain financially constrained. In the end, the gym industry illustrates a simple but uncomfortable truth. High demand does not guarantee high profit. Even businesses built around health and self-improvement can struggle when their economics depend on inconsistency. The equipment is durable. The model is less so.